Financial markets started the second quarter of 2025 firmly on the back foot, with the US's Liberation Day tariffs causing panic in markets. In early April, the S&P 500 suffered its fifth worst two-day drop since World War II, plunging more than 10%. However, markets then staged a dramatic rebound after President Trump announced a 90-day suspension to the tariffs for non-retaliating countries. Some trade deals were announced, and we do expect more to come, while the One Big Beautiful Bill Act in the US provided support at the end of the quarter via a strong expectation for more fiscal spending to come. Equity markets actually rallied quite impressively from the lows, buoyed by resilient economic data, falling inflation, and hopes for rate cuts later in the year. The quarter also saw some geopolitical shocks, notably in June when Israel struck Iranian nuclear sites, prompting retaliatory missile attacks, and then the US also launched targeted attacks, which sparked fears of a regional conflict. Around that time, oil spiked to almost $80 a barrel, but then retreated as a ceasefire was thankfully reached. The S&P 500 reached a new all-time high, gaining 11% for the quarter, while Japan's Nikkei rose by 14%, and emerging market equities posted their best quarter since the final quarter of 2020, up about 12%. Meanwhile, US fiscal concerns resurfaced after Moody's downgraded their sovereign credit rating. That pushed the US 30-year bond yield up to about 5.2% intraday, and settled at the end of the quarter at around 4.8%. Despite many negative news items, economic fundamentals actually remained resilient. Growth in US non-farm payrolls was above 140,000 a month. US and Euro area manufacturing indices stayed in expansionary territory in June, and inflation surprised to the downside, which does leave room for potential rate cuts by the end of the year. Central banks remained quite divergent in policy. The US Fed held rates steady, the European Central Bank cut rates twice, but the Bank of Japan increased rates, and this divergence underscored the contrasting economic trajectories between those three areas as the first quarter closed. From a style perspective, growth really did come roaring back in the second quarter, rising almost 18%. By contrast, the value factor struggled. That was up only about 5%, as the market took a decidedly risk-on tone. When we look at sectors, the key positive story was the 23% jump in technology stocks, really driven by index heavyweights Nvidia and Microsoft. Healthcare and energy names were down around 4 to 5% for the quarter, while mining did all right. More cyclical sectors like financials and consumer discretionary outperformed as well. In essence, this was the opposite of the first quarter. Global bonds were up about 4% in dollar terms in the second quarter, really driven by the weaker US dollar, as global trust in the US declined in general around the tariffs. In the commodity space, oil was down almost 10% over Q2. Gold saw a more muted performance after its very strong rally in the first quarter. That was up only about 6% in Q2. When looking at South Africa, the rand strengthened by about 3% over the quarter as a whole, although the path was certainly quite volatile. By the end of June, it was more than 10% stronger than it had been on the 9th of April at its lows at that point. South African stocks had another good quarter, despite the drop in the first days of the month, so they were up about 10% over Q2. Platinum mining shares certainly led the gains, with Northam and Impala Platinum rising about 46% and 26% respectively. Naspers also performed well. That was up 22%, as improving profitability in its portfolio, excluding Tencent, became more evident. Domestic-focused sectors in South Africa continued to lag, with banks gaining only about 0.5% and general retailers declining around 5%. That was really hamstrung by slow economic growth in our country. South African bond yields behaved quite well, though, with the 10-year bond falling during the quarter in terms of yield. So that resulted in a 6% total return for the All Bond Index. That also provided support for the South African listed property sector, which was up about 9% for the quarter. Our worldwide equity portfolio's performance over the second quarter was quite healthy in absolute terms, delivering north of 6% in rands. Over the last 5 years, this portfolio has returned around about 13% per year after fees, which is about 8% a year ahead of inflation. After strong relative performance in the first quarter, this portfolio lagged a bit in the second quarter, which is very much to be expected given our focus on higher quality businesses, which of course had not fallen as much in the first quarter, particularly on the international side. The worldwide portfolio is still in the top 15% of its peer group over the last decade. Our South African equity portfolio lagged its benchmark in the second quarter. That was more driven by the sharp fall in Aspen after they lost a contract. Naspers Prosus, though, it's our largest exposure in the portfolio, and its strong performance in the quarter means we again have the enviable problem of the position size starting to become uncomfortably large. This portfolio remains in the top quartile of its peer group over 10 years. It's delivered about 15% per year over the last 5 years, which is about 10% per year ahead of inflation. If we move across to our Regulation 28 multi-asset portfolios, the short-term performance, little disappointing. Balanced, moderate, and conservative balanced portfolios were about 1% behind their benchmarks in the second quarter. Again, their low-risk style struggled a touch as the equity market rebounded. These portfolios are all ahead of their benchmarks over 10 years, and over the last 5 years, they've delivered 4 to 6% per year ahead of inflation, which is very much in line with their risk tolerance. If we look back at the activity in the portfolios in the second quarter, the April crash and the associated fear there created opportunities both locally and globally, although the window was quite short. Within South African equities, we took advantage of this, deploying some available cash into Sanlam shares, and then later in the quarter, we added further to SA Financials by increasing our exposure to Standard Bank at quite an attractive valuation. That's got a 7% dividend yield and about a 7 times forward price to earnings multiple, so we expect this to do very well for our clients over the coming years. We funded that addition by trimming our exposure to British American Tobacco, where the price breached our fair value after some very strong performance over the last year. In our global direct equity portfolios, we also took advantage of the April turmoil, where we reduced our holdings in more defensive names like Becton Dickinson and Chicago Mercantile Exchange, which had of course held up well through the crash, and we recycled that cash into higher growth businesses, including the likes of Microsoft, which I mentioned earlier has done very well this quarter, and Amazon. And that participation in the tech rally was quite encouraging. Overall, our positioning across our portfolios at the end of June was marginally underweight equities at an asset class level and was slightly conservative in terms of stock selection within equities. And then within equities, from a global perspective, we are overweight South African stocks and underweight global stocks. Those are now starting to look quite expensive with markets at record highs. We're also overweight South African bonds, and we distinctly underweight cash in our multi-asset portfolios. While South Africa's current economic situation doesn't look particularly exciting, we think that there's quite a nice combination of external factors that is working to improve our economic outlook here. Gold and platinum prices are materially higher than they were at the beginning of the year, and that should help both the rand as well as government finances from the taxes they receive. The rand oil price is also below where it was last year, and inflation's only around 3%. All of that provides actually some relief for consumers. We then see interest rates that are lower than a year ago, and we expect a further cut in late July. Again, that should help consumers. And then finally, we've got the Government of National Unity, which, despite its wobbles, does appear to be holding together. And we think that helps both confidence and the price of government debt. And if we are able to keep this combination of factors in place, we do think it might just be the beginning of a virtuous economic cycle for our country. Globally, though, if we look past the tariff noise, disinflation is definitely underway. It's bolstered by softening demand indicators, easing labor markets, and declining price pressures. Private balance sheets are generally healthy, credit spreads are contained, and there is room for monetary accommodation if the growth slows further. Equity supply versus demand is quite supportive, with investor positioning around about neutral, and share buybacks are continuing at quite a brisk pace in the US. All of these factors together create quite favorable conditions for markets, provided the momentum isn't disrupted by some sort of new escalation in geopolitics or potentially adverse policy developments. Within the portfolios, we maintain a healthy balance between quality, valuation, and cyclical opportunities. However, the defensive and quality bias of the portfolio does result in a lower beta portfolio relative to our benchmarks. So our performance may lag slightly during sharp market rallies, but provide much lower drawdowns during potentially declining markets in future.